Welcome to Module 2 of Master Trader's seminar on generating income from selling credit spreads with charts. In this module, we're going to review the necessary foundation of options trading and terminology necessary for you to sell these high probability credit spreads. What is an option? It's a contract allowing for the right, but not the obligation, to buy or sell something during a specific time for an agreed upon price. The premium is quoted per share, which means one contract represents 100 shares of the underlying. A call buyer, they pay money for the right to buy stock. They're bullish. They expect the underlying stock to move up. A call seller takes the opposite side of the call buyer's bet, receives that premium, and they assume an obligation to sell the stock at the agreed upon price on or before expiration, and that's taking a bearish position of the stock. Selling options, though, increases the probability of profit, which we're going to keep drilling into you, that concept. We're going to teach you how to sell bear call credit spreads, so we're going to be selling this call option, and we'll show you how to buy another one to limit risk with the charts for profit. So the option buyer is paying the money that's going into the pocket of the option seller, and the option seller is assuming an obligation for taking that money. Again, that's the same definition of an option, but now we're going to talk about puts. A put buyer, they're paying for the right, but not the obligation to sell stock. So they're bearish. They want the price of the stock to move down. The put seller receives money for assuming an obligation to buy the stock. They're bullish. We are going to teach you in this course how to sell puts on bullish patterns, and then a bull put credit spread. We're going to show you how to buy another further out of the money put just to limit your risk and cost. Now let's get familiar with a typical option quote screen, because this is what we're going to be buying and selling in these credit spreads. Thinkorswim is owned by TD Ameritrade. This is what I've been using for over a decade, and I love it. So I'm just going to use Apple here as an example, trading at 170.15. That's the symbol, current stock price, and the change. It's down 95 cents on the day. Calls are on the left, puts on the right. The ask price is the amount you can buy this call option at or buy this put option at. A bid is the amount you can sell the call for or sell the put for. And we're going to teach you how to put on all trades at midpoint, or at least attempt to. Expiration date, always listed right here, at least on Thinkorswim. Most should be pretty darn similar. So this particular Apple option expires December 15th of the year 2017, and it has 20, that's in the parentheses here, that's the days to expiration of this contract. You have 26 days before this contract expires, and it's either going to expire with intrinsic value, so it has value, or it's going to expire worthless. We will get into those terms shortly. So that's the expiration here also, December 15th. It's the last day that an option can be exercised. The strike price, that's this box right here. The strike price is the price that the stock will be delivered in the event an option is exercised. So do you remember we said in the definition of calls and put of an option, it's the agreement to buy or sell something at an agreed upon strike price. That's what this is. So these parties are agreeing to exchange Apple stock to buy or sell it at $170, whether you're a buyer or a seller of a put or a call. These are the puts on the right. At the money is another term. It's the strike price closest to the stock price. So the stock price is 170.15. It's very rarely going to be exact unless it's right on the exact penny. So at the money just refers to the closest strike price. In the money is going to be different for calls versus puts. We're going to get into that shortly also, so not to worry. But since we're looking at puts here, in the money means it's the immediate value if exercised. So if it's trading at 170.15 and you have a contract to sell it at 175, that has intrinsic value. But again, we're going to get to some other examples on that for calls and puts. Delta. And we use this as 3 different ways to look at it. And here's where it's shown, delta, this column on the left, calls. Here's the delta for my puts here. At the money delta has roughly a 0.50 delta. Now a 1.0 is what stock is. Let's look at these 3 descriptions of delta. It's an amount that the option should move for every $1 move in the stock. The 170 at the money, if Apple goes up $1, your 170 call option should go up roughly 50 cents. If Apple goes down $1, your 170 put should go up in value roughly 50 cents. Here's another way of using delta. It's the rough equivalent to a directional position of that amount of stock. If you bought 1 contract of the call option, the 170, remember we said that 1 option equals 100 shares. So 0.51 of 100 shares would be roughly 51 shares. So if you bought a 170 call option, that would be roughly the equivalent of owning 51 shares of Apple. And we'll get into this more later, but the deeper in the money that you go on the call side, the delta is higher because it's moving closer with the underlying stock, which is Apple in this case. The final way that we use delta is the probability that the option should expire in the money. In Module 3 on selling bull put credit spreads, we're going to be selling out of the money puts, and the deltas are typically going to be 0.30 or smaller. Again, we'll get to that later. But that means, so this 160 put, for example, statistically only has a 14% chance of expiring in the money. And so the opposite of 14% expiring in the money is 86% probability of it expiring out of the money. And when we're selling credit spreads, our objective is for them to expire out of the money every single time. And then that premium that we took in is 100% profit. Now let's dig in a little bit more and look at intrinsic value and time value. Every single option price you look at, I just want you to look at it in terms of those 2 items, intrinsic value and time value. So this is the ones, these are the call options for Apple. I just took a screenshot of the bigger screen that we already looked at. So if Apple is trading at 170.15, we already said the at the monies are 170, and this is what they're trading at, 350 a share by 360 a share. So let's start with this one, the 170 strike price. Intrinsic value is 15 cents. Why do I say that? Well, if you have a contract that allows you to buy Apple stock at 170 a share and it's trading on the open market at 170.15, then that has 15 cents of intrinsic value. You can also think of this as like a coupon. You have a coupon to buy Apple at a certain price. So if wherever Apple's trading at that point in time, if you have a coupon to buy it a whole lot cheaper, that's intrinsic value. Everything else of the cost of that option is what's called time value or extrinsic value. We're going to be selling that time value is how we profit on these short credit spreads. So back to the 170s. It's 350 by 360. So if I bought 1 contract at 360, remember that's 100 shares, so that's $360. So 0.15 of that is intrinsic value. So the entire difference is 3.45 a share is time value of this $170 call. Now let's go to the $165 call, which is right here in the money. It costs $670 by $695. I'm not going to worry about midpoint right now as we walk through these definitions. So one contract, if you bought a $165 in the money Apple call option, is $695. How much of this one is intrinsic value? Remember, if I have a coupon or contract that allows me to buy Apple at $165 a share and it's trading at $170.15, well, then I have $5.15 of intrinsic value. Everything else is time value. So I take $6.95 a share less $5.15 a share. That's how I get my $180 a share. And this is just the Apple stock, just for the fun of it. So you can see they're trading at $170.15. Now, the $175 is considered out of the money. Out of the money means it's 100% time value. If I have a coupon or contract that allows me the right but not the obligation to buy Apple at $175, then it's trading at $170.15, so there's no intrinsic value. But if I have to buy that contract at $1.56 a share, then that is 100% time value. Now we're just going to look at we're going to go through the same exercise, but we're looking at put options. Now remember, if you're long a put option, you have the right but not the obligation to sell Apple at that agreed upon price. But let's continue. So the at the money we already said was the 170. This is the price, 320 by 335. So let's start with the 170 down here. If I have a coupon that allows me to sell Apple at $170 a share, but it's already trading for higher than that on the market, then that coupon has no value if you were to exercise it right then. So it has intrinsic value of nothing because the stock is trading for higher than your coupon amount. So if I paid $3.35 for this put contract, this 170 strike price is 100% time value. I'm layering concepts on you. So time value cost money. And so the speculator that would buy this put contract is betting on lower prices. But if Apple doesn't fall, the value of this 170 put is slowly going to zero. And I'm jumping the gun a little bit on purpose, but that is the concept that we're going to use around charts to take advantage of that time decay. But let's continue with the definitions. So if I have a coupon that allows me to sell Apple at $165, that's worth zero. I'll go to the open market and sell it instead of selling it to you for $165. If you paid $1.57 for that contract, that's all time premium. Let's go to the $175 strike price on the put. If I have a coupon or contract that allows me to sell Apple at $175 a share, but it's only trading at $170.15, that has $485 a share of intrinsic value. Everything else on this amount of $645 is time value. That's a explanation of intrinsic value, time value, both on call options, put options. And next definition is open interest. So you now know what calls are, you know what puts are. This column of open interest are the total amount of options outstanding. They haven't been exercised and they haven't been expired. So they're out there in the marketplace. Buyers and sellers of those contracts are waiting to do something with them. So it's open interest. And then the same on the put side. We recommend you only trade highly liquid options. And you want those with the highest volume traded, and the highest open interest. So these are big numbers, and Apple is one of our favorites. It's very liquid, as is spiders, etc. We actually have a list on our website. You can go there and download it. We have a customized list of liquid options that we like to trade. Implied volatility and expected move. So this, on my platform, Thinkorswim, it's just right here. It's to the right of this particular strike and expiration. 21.19% is the implied volatility of this option. And that's based upon the prices of these options. They calculate the implied volatility. And that estimates how volatile the marketplace expects Apple to be within the next 26 days. And they also just give us a nice parentheses here that says these option prices based upon this implied volatility has an expected move plus or minus, because the option prices don't calculate up or down because they don't know. But a $7.83 move up or down is what these option prices are implying. So we call that the expected move. And we're going to use that also in selling these credit spreads. Factors of option pricing. I know I just said it's intrinsic value or time value, but this kind of shows you a little bit of, what makes up some of that time value also. So the total option price, like we just looked at on Apple, you saw drastic changes depending on if it's in the money or out of the money. It's going to affect the total price of the call or put option. Higher the intrinsic value, the more it's going to cost. Expiration date, time, cost, money. Just like an insurance policy on your car or your house. Do you want a 3-month policy, 6-month, year, time, cost, money? Because the option seller is assuming risks and obligations, and they want to get paid for it, just like the insurance company. Implied volatility, I just showed you the implied volatility on Apple. I'm going to show you in a moment the implied volatility of the overall market, so to speak. But the higher the implied volatility of the option that we're selling, the more we're going to get paid in selling them, because they cost more with higher volatility. And we're in this course, we're going to be using that to our advantage because we are selling these options. Dividends is just another component of option pricing. The way we trade, you shouldn't have to worry about that because we stop out before they're deep in the money. But dividends, calls are less expensive and puts more expensive leading up to the ex-dividend date. And ex-dividend date is the date where record owners before that date get the dividend. So just keep that in mind, but it's not going to be a big issue for the way we're selling credit spreads. Theta, you don't need to remember the name, but I'm going to go through it because this time decay and theta is the predominant reason of why these credit spreads are providing us with the monthly income. Theta, by definition, is measuring the rate that those options are losing their value. Time costs money. Option buyers have a wasting asset on their hand, and theta measures how much that's going to deteriorate day by day. 85% of options expire worthless. So that alone, ladies and gentlemen, should tell you, why do you want to buy them if 85% expire worthless? And that's another very clear reason why we are option sellers. But again, not just mathematically. We do them around the chart, which increases our accuracy tenfold. Time decay to the buyers. So if you buy an option, that's our income. What's hurting option buyers is helping option sellers. Now, so this is key. Time premium decays rapidly into expiration. So if you can see here, this is 120 days, 90, all the way to 0. This theta, or time decay, as it approaches expiration, and particularly in the last 30 days, you have the most rapid time decay. And that's why we specialize in selling these short-term options with the charts. Sometimes go up to 45, but we prefer short-term, 1 to 2 to 3 weeks. So if we can make our money and not be exposed to the market for a long period of time, then we're getting paid more for the short risk that we're taking. Just another few points here about theta. Theta shows the amount that the option's extrinsic value should decay per day, all other Greeks constant, which I just mentioned. You don't need to know this, but when we short options, that's what's called long theta. That's our daily paycheck. Selling options is giving us a cushion to be wrong about the direction. Ideal combination is we like high implied volatility with our compelling pattern. And here's old Tom Cruise, show me the money, show me the long theta. Theta is what we get paid day by day, as long as the stock is not drastically going against us. Now here I promised I wanted to show you what volatility on the overall market was, as opposed to, remember Apple, I showed you the implied volatility of those Apple 26-day to expiration calls and puts. So the VIX is the volatility index, the SIBO volatility index, and you cannot trade this instrument. It just shows you it's a measure of the market fear or uncertainty. Every time it rises, the VIX rises, fear or uncertainty is rising, and that's increasing the demand and cost of put options, and that's why the prices of them go up. So high volatility equals high option prices. And this chart down here is just it's volatility of volatility. And we have a whole specialty course on trading volatility ETFs like this. And it's an amazing course because not only the edge that we're getting in selling credit spreads in this course, but it's like an edge on an edge of selling volatility. But that's beyond the scope of this course, and you don't need to know it. You just need to know high volatility is a plus in selling credit spreads, again, because we're getting paid more. That's it for Module 2, and we look forward to meeting up again in Module 3, where we're going to now start implementing what you've learned and selling bull put credit spreads with compelling chart patterns. Stay tuned.